Hi, today we are going to look at relevant costing. And I really just want to explain the basic principle of this topic. So I'm just going to look at the basic principle. And I think once you really understand this basic principle, you can apply it to whatever scenario you are facing. And it's really useful. So relevant costing is also known as differential cash flow analysis. Now I prefer this name because it's more explanatory, tells us a bit more about what we're doing. We're doing an analysis and it's basically on differential cash flows. Relevant costing might be difficult to just understand what exactly it's about, and also costing, it makes me think that we're only looking at costs when in fact we're looking at all cash flows, whether they're inflows or outflows, revenues or costs. And so really this is the better definition. But basically what relevant costing is, it's a tool to analyze strategic decisions within a company. And these decisions can either be short-term, so we're looking at a time frame that's shorter than 12 months, so shorter than 12 months, or it can be long-term. The decision affects the company over a number of years and usually greater than 12 months. Now, really important when we look at relevant costing is to know that there is an assumption that underlies our analysis. And that assumption is that we are approaching this decision from the viewpoint that we want to maximize our company's financial value, the company's financial value. In other words, basically we want to maximize the company's share price. So maximize the value which is equal to your share price. And this is also referred to as economic rationality. We're going to approach this decision in a rational way from an economic viewpoint, meaning that we want to maximize the company's value, financial value, which should result in us maximizing the share price. Now, you'll remember from what you learned in corporate financial management that we maximize the share price where we maximize our future cash flows. Because the share price today is equal to the present value of our future cash flows that the company generates, and specifically those cash flows that are available to shareholders. So we get the present value of these future cash flows using an appropriate discount rate, and that's how we determine the share price. So how does this impact what we do during our differential cash flow analysis, and how does this impact with what we do when we make a decision? So let's look at it from a specific company's perspective. So we have company A, which manufactures things. So there's some pollution going out there. Well, it's using energy to manufacture goods. And this company has a specific timeline. It has a past, it has a present, and it has a future. So at the beginning it was incorporated, and that would be the start of the company. It has a present, so we have today, the present day, and it has a future. So if this is today, then anything that happens in the future, anything that happens from here onwards is considered to be the future, and anything that happens from here happened here is considered to be the past. Now, this company has made specific decisions in the past. They've decided to invest in certain projects. They've decided to launch certain products and buy certain machinery that would result in the company making future cash flows. So the decisions they've made result in future cash flows being made as it stands. And those future cash flows, if discounted back to the present, gives us a certain share price. Now, let's say that this company, the total cash flows that this company is going to make in the future is equal to X rands. So we have total cash flows of X rand. And these cash flows happen as a result of decisions that were made in the past. And if we discount these cash flows back to the present day, we get a share price of Rand X. Now, if the company was faced with making a decision today, a strategic decision, and once again, this could be, should they purchase a certain machine or should they launch a product? Some other decisions companies have to make is whether they should outsource certain functions within the company or even close certain divisions. And so they have strategic decisions that they need to make. Now, for our purposes, let's say this company is specifically looking at whether, so we have a decision of whether we should close a division. As it stands, the company is not going to close the division and therefore would make X cash flows. But now, if we were to close the division, something would change. Now, we now have an option of two futures. We have future A, which is the status quo, and we have future B, which would be what would happen if we were to close this division. And future B will result in different cash flows. Why cash flows? And because the future cash flows are now different, it will result in a share price that's different if those cash flows are discounted to the present day. Now, if we go with the assumption that the company wants to maximize the financial value of that company, so we want to maximize the financial value and therefore maximize the share price of today, it means we want to maximize the future cash flows. And a rational manager would choose the future that results in the highest cash flow. So if the cash flows from future B is higher than the cash flows from future A, then we should close our division, because from an economical point of view, it makes sense. It's going to maximize our share price. However, if the cash flows from future B, so the RY cash flows, is smaller than the status quo or the future A cash flows, then we should keep the division open. So really what we're trying to do when we're analyzing a strategic decision is we're trying to determine, well, what will the new cash flows be under future B, And as a result, what is the decision we need to make that's going to maximize the share price of today? And so differential cash flows is really looking at to what extent will the cash flows between the two futures be different, differential. And so that really is what relevant costing is. We look at to what extent will the cash flows from our new future or new possible future be different to the cash flows of the status quo. And if it's higher, we make the decision to close the division, and if it's lower, we make the decision to keep the division open.